Thank you for joining us in this segment 2 of our professional advisor training webinar series. This one is going to discuss about tax policy and its implications on captive insurance company solutions. I'm Tom Cifelli, the Managing Director of Captive Experts. You might wonder what qualifies me to talk to you about tax policy. It's an implication on captive insurance companies in the industry. And I'm certainly not the world's most foremost expert in anything, but I do have a lot of applicable career experience impacting the information I'll share with you today, and I hope you enjoy this viewpoint, actually. Earlier in my career, I worked with the world's largest tax accounting organization in their global corporate tax headquarters as a tax CPA and as a tax law researcher. I also was the lead research assistant updating, at the time, the most widely used tax text in law schools in the United States. That was a taxation text originally written by the Dean of Harvard's Law School and then subsequently co-authored and updated, and today written and updated by the leading tax professor in the U.S. law school system in the United States. I also was, editor of a major tax planning journal and have other applicable experience. But tax policy has always been one of the intellectual areas of greatest interest to me because I think it has a much greater impact on our culture and civilization and relationship toward each other and private property rights than people realize. So this 10-minute webinar is going to give you a tax policy overview so you can see where captives fit in the bigger landscape. It's going to give you a really good insight as to where captives fit in the relationship to tax impacts. Let's compare captives to a lot of other areas where investment would likely not occur at a much smaller level occur, but for tax incentives. Retirement savings. Who would be investing in 401ks and Roths and defined benefit plans and the like, even retirement-oriented products like annuities, tax-deferred annuities, but for the tax incentives. The reason they're there is the government appreciates the importance that people plan for retirement and set money away. Otherwise, the government would have a much even greater challenge in terms of required safety nets and welfare programs and the like for lots of people, especially the elderly and people who are exiting the workforce. So tax incentives underlie a big shift in capital and an incentive for people to save and plan for retirement, so government doesn't have to worry about taking care of everybody. Employee benefits. This is probably one of the areas which is the greatest investment by the U.S. Department of Treasury in terms of lost revenues because of the tax incentives that allow a deduction for providing employees with health insurance, yet not requiring those employees to include that benefit in most cases, in their taxable income. Through tax incentives, the U.S. government heavily subsidizes provision of health coverage to people around the country as they do retirement savings. About home ownership, the deductibility of home mortgage interest is a significant subsidy to the industry. And I'm not sure, if that's really the piece homeowners who want to buy a bigger house than necessary, or if it's, just part of the incentives that help fuel demand for the banking and financial industry products. Either way, it's a huge economic impact in the economy, and it's a big subsidy to residential real estate. Real estate in general is a hugely tax-favored industry. There's all kinds of tax incentives targeting it, not just interest deductibility, but depreciation allowances, 1031 tax-free exchanges, et cetera, et cetera. So real estate development investment has been widely fueled by tax incentives as well. Business equipment investment, accelerated depreciation and the like stimulates that economic activity, which, all of these things translate into a healthier, larger, more robust economy and better job growth for our citizens. Research and development, any green initiatives, those have lots of tax incentives subsidizing investment in those areas. The government feels appropriate to assist in. Charities and religious organizations, huge buckets of tax revenue lost by subsidizing the management and operation of those organizations. Well, captives are part of risk management, and insurance products and insurance companies also have significant tax incentives. So you should understand that that's part of our federal policy, and it's part of our culture. It's ingrained in our culture, and it's proven highly beneficial. So you shouldn't worry as an advisor that things are going to change rapidly. You should be bringing insurance-related tax incentive opportunities to your clients' attention so that they can go ahead and make strategic decisions based on utilization of them. If you consider the night sky, with every star up there being different tax incentives in our code, the amount of incentives benefiting captive insurance companies would be so minuscule you wouldn't even see the star compared to these other areas I talked to you about. And that's probably not a good thing. It's a good thing in the sense that the tax incentives for captives should remain and have longevity. They've been around for decades now, and it should continue. But actually, it's a bad thing because there probably should be more incentives for expanding enterprise risk management investment. You'll see that in a later slide. But let's talk specifically about what the tax policy incentives behind captives are. Captives are the most cost-effective, strategic risk management tool available for enterprises today to improve risk management and improve their insurance portfolio investment coverage. What underlies the tax incentive structure is, one, the deductibility of insurance that you buy, whether you buy it from a commercial insurer, whether you buy it from your own customized captive insurance company. That's a related affiliate. Secondly, insurance companies themselves have special rules. Commercial carriers and captives all benefit by special accounting and tax rules. They allow you to accrue and deduct against income tax reserves for a variety of loss expectancies. The technical terms in the industry is IBNR and case reserves, et cetera, et cetera. But just understand this, insurance companies and insurance companies alone are allowed to create deductions against income for things which haven't yet happened, but actuarially might. And that's kind of unique. That's a significant tax incentive to insurance companies, and it makes the products that they can offer and sell to businesses less expensive. Life insurance is like an example, but it's not a business product for most people. But the proceeds of life insurance policies is tax-free to the recipient, and all the investment accumulation inside it was tax-deferred and tax-free. It's a heavily subsidized product, and it allows people to buy life insurance much more affordably than they otherwise could. And so obviously the tax incentives underlie a governmental policy that's an important thing to encourage people to invest in. With respect to captives, and especially small captives known as enterprise risk captives or micro captives, or sometimes referred to as 831B captives, that are growing in application today and interest. That Section 831B of the Internal Revenue Code is special just to small insurance companies as defined in the code. That means insurance companies that only do 1.2 million or less in annual earned premium business. This provision was enacted in 1986 during Ronald Reagan's second term as president as part of that 1986 Tax Reform Act. It was enacted for a lot of reasons that are still valid today, and probably even more so today than they were at that time, because the risk businesses face today is expanded, as you'll see in the next slide. But anyway, that election exempts the small insurance company from income tax on its premium revenue, on its underwriting income, which is an incentive that the larger insurance companies don't even have. But it really encourages customized smaller insurance company formation and application to improve risk management. The reason nobody heard about 831B, 2 decades ago, even though it's been on the books since '86, is because the IRS always challenged captive arrangements. In 2001, they changed their position on that, largely because they lost in court over and over. Courts recognized these arrangements. And the IRS in 2002 went further and adopted some revenue rulings which are foundational, guidance for the creation, design, and operation of small insurance companies. And more guidance should be expected from the service to make sure they're comfortable with how captives are being designed and operated today because of the increased growth. In any event, that change in position underlies why captives are now more important and more available to businesses of all sizes in the United States. And it's a good thing. There's a huge consensus that there's a need for more investment, not less, in risk management. Captives are, the number one strategic tool to improve enterprise risk management with. The U.S. Government Accountability Office, the GAO, this year indicated that there's all kind of risks of serious concern that the government, the Congress and the President need to address more effectively. And it is, to the extent they have the capacity, they and other countries need to invest more in as well. That's environmental risk, energy risk, financial, human capital, infrastructure, supply chain, you name it. The list is long. On the private sector side, Aon does the best job of doing an annual risk survey. Aon, as you know, is that tiny little company with offices in 100 plus countries, and tens of thousands of employees. They send a survey out every year to their client base around the world, and about 30% of the respondents were U.S.-based companies. And they asked them, what are the risks you're concerned about, and what kind of investment are you making in insurance products, and what else are you doing to better manage your enterprise risk? Well, that survey listed 50 different types of risks of major concern to companies around the world, most of which are not adequately, if at all, addressed by commercial insurance products. That is creating a huge, compelling case right there for why you should have a captive insurance company. Customize your insurance program, not only improve the commercial components, but also address all these other areas of enterprise risk that are being neglected and you're not properly funding reserves for. So, in a nutshell, that's basically what this tax policy webinar was meant to convey to you. Where captives fit in the bigger pictures of tax incentives and the treasury investment in this industry compared to many others subsidized heavily with tax incentives, and why there's a need for greater investment risk management in captives today. If you have questions and we could help you with anything, please reach out. You can contact me directly. You can visit our websites. They're loaded with information. And we look forward to working with you in the future. Hopefully this webinar was helpful.